Welcome to Black Hill Intelligence. In today's video, we're diving into a topic that affects nearly everyone at some point in their financial journey: personal loans versus credit cards. Whether you're looking to finance a major purchase, consolidate debt, or simply cover everyday expenses, understanding the differences between these two borrowing options is crucial for making smart financial decisions. We'll break down what personal loans and credit cards are, how they work, and the pros and cons of each. We'll also guide you on when to choose one over the other, helping you navigate common pitfalls to avoid costly mistakes. By the end of this video, you'll have a clearer picture of which option suits your needs best and how to manage your finances responsibly. So, if you're ready to take control of your financial future, let's get started. Personal loans. A personal loan is a type of unsecured loan that provides a borrower with a fixed amount of money to be repaid over a set period, typically ranging from 1 to 7 years. These loans are usually used for specific purposes, such as debt consolidation, home renovations, medical expenses, or large purchases. Since personal loans are unsecured, they don't require collateral like a car or a house, which means the lender relies heavily on the borrower's credit score and financial history to determine the loan amount, interest rate, and repayment terms. Personal loans often come with fixed interest rates, meaning the monthly payments remain consistent throughout the loan term, making budgeting easier. Interest rates on personal loans can vary significantly depending on the borrower's creditworthiness, ranging from as low as 6% for those with excellent credit to upwards of 36% for those with lower credit scores. One of the main advantages of personal loans is that they typically have lower interest rates than credit cards, especially for borrowers with good credit. However, they also come with potential downsides, such as origination fees, prepayment penalties, and the risk of falling into long-term debt if not managed carefully. Credit cards. A credit card is a financial tool that provides a revolving line of credit, allowing users to borrow funds up to a predetermined limit to make purchases, pay bills, or withdraw cash advances. Unlike personal loans, credit cards do not have a fixed repayment schedule. Instead, users must make at least a minimum payment each month, with the option to pay off the full balance or carry it over to the next billing cycle. Interest, known as the annual percentage rate or APR, is charged on any unpaid balance, often at rates significantly higher than those of personal loans. Credit cards are convenient and flexible, making them ideal for everyday expenses, emergency purchases, and building a credit history. Many credit cards offer rewards programs, such as cashback, travel points, or discounts, which can provide additional value to the cardholder. However, the high interest rates and potential for accumulating debt make credit cards a financial tool that must be used responsibly. Carrying a balance month to month can lead to substantial interest charges, and consistently maxing out a credit card can negatively impact one's credit score. Therefore, while credit cards offer significant benefits, they require careful management to avoid debt pitfalls. Personal loans and credit cards comparison. Personal loans and credit cards are both tools for borrowing money, but they serve different purposes and have distinct features. Personal loans provide a lump sum of money that is repaid in fixed monthly installments over a set period, typically with a lower interest rate than credit cards. They are ideal for large, planned expenses like home renovations, debt consolidation, or major purchases. Since personal loans have fixed terms, they offer predictability in budgeting, with a clear timeline for paying off the debt. Credit cards, on the other hand, offer a revolving line of credit, allowing users to borrow up to a certain limit and repay the debt over time with no fixed repayment schedule. They are more flexible, making them suitable for everyday expenses, emergencies, and smaller, frequent purchases. However, credit cards typically come with higher interest rates, especially if the balance is carried month to month and can lead to significant debt if not managed carefully. The choice between a personal loan and a credit card depends on the borrower's needs, repayment ability, and financial goals. Personal loans are better for larger, one-time expenses with a clear repayment plan, while credit cards offer more convenience and flexibility for ongoing spending. Before we dive deeper, if you're finding this information helpful, don't forget to hit that like button. It really helps our channel grow and reach more people who could benefit from this content. And if you haven't already, make sure to subscribe and turn on notifications so you never miss out on our latest videos. We've got plenty more tips and guides to help you make informed financial decisions. Now, let's get back to the topic. Decision-making guide. Choosing between a personal loan and a credit card depends on your financial needs, goals, and repayment capability. Here's a quick decision-making guide to help you choose the right option. Purpose of the funds. If you need to finance a large, one-time expense like a home renovation, medical bill, or debt consolidation, a personal loan is often the better choice. It offers a fixed loan amount with a clear repayment schedule, making it easier to manage. Repayment flexibility. Personal loans have fixed monthly payments over a set term, providing predictability. Choose this if you prefer a structured repayment plan. On the other hand, credit cards offer revolving credit, allowing you to pay off as much or as little as you want each month. This flexibility is useful for managing smaller, ongoing expenses. Interest rates and costs. Personal loans typically offer lower interest rates, especially for borrowers with good credit, making them cheaper for large amounts. Credit cards often have higher interest rates, but if you can pay off the balance in full each month, you can avoid interest altogether. Credit impact. Both options affect your credit score, but differently. Personal loans improve credit by adding installment debt, while responsible credit card use can build a strong payment history. Choose based on your credit-building goals. Assess your financial situation and choose the option that aligns with your needs, repayment ability, and long-term goals. Common pitfalls and how to avoid them. When using personal loans and credit cards, certain common pitfalls can lead to financial stress if not managed properly. Here's how to avoid them. Personal loans. Borrowing more than needed. It's tempting to borrow a larger amount than necessary, but this increases your debt and the interest you'll pay over time. Avoid this by borrowing only what you need and can comfortably repay. Not understanding loan terms. Some loans come with hidden fees, variable interest rates, or prepayment penalties. To avoid this, thoroughly review the loan agreement and ask questions before signing. Taking multiple loans. Managing several personal loans can become overwhelming and lead to financial strain. Avoid this by consolidating your debts or ensuring you can manage repayments before taking on additional loans. Credit cards. Carrying a balance. Paying only the minimum each month leads to high interest charges, causing debt to accumulate quickly. Avoid this by paying off the full balance whenever possible. Maxing out credit cards. Using too much of your available credit negatively impacts your credit score and can make it hard to manage debt. Avoid this by keeping your credit utilization below 30% of your credit limit. Ignoring fees. Late payment, annual, or foreign transaction fees can add up. Avoid this by understanding your card's fee structure and setting up automatic payments to avoid late fees. By being mindful of these pitfalls, you can use personal loans and credit cards effectively and maintain financial health. Conclusion. In conclusion, Both personal loans and credit cards are valuable financial tools when used wisely, but they serve different purposes and come with unique advantages and risks. Personal loans are best suited for large, planned expenses or debt consolidation, offering the benefit of fixed payments and lower interest rates, especially for those with good credit. They provide structure and predictability, making them ideal for those who prefer a clear repayment plan. Credit cards, on the other hand, offer flexibility and convenience for everyday spending, emergencies, and short-term borrowing. They can be a powerful tool for building credit and earning rewards, but they require disciplined management to avoid high-interest debt and negative impacts on your credit score. When deciding between a personal loan and a credit card, consider your financial needs, repayment ability, and long-term goals. Borrow only what you need, understand the terms, and manage your payments responsibly. By doing so, you can leverage these financial products to your advantage, maintaining control over your finances and achieving your financial objectives. Remember, the key to successful borrowing lies in informed decisions and careful management. Thanks for watching. We hope this video gave you a clearer understanding of personal loans and credit cards, helping you decide which option is best for your financial needs. If you found this information valuable, please give it a thumbs up and share it with anyone who might benefit. Don't forget to subscribe to our channel and hit the notification bell so you never miss out on our latest content. We'd love to hear your thoughts or any questions you have in the comments below. Until next time, take care and stay financially savvy.